Wolfspeed fell 7.7%. Lab scores 50 out of 100. Hold. The Greensboro plant must hit 150,000 wafers per month to unlock AI power density gains across data centers. Current output lingers around 50,000 wafers, making the threefold ramp a near-term execution risk. Our deep dive shows why the fab ramp decides Wolfspeed's AI destiny and valuation trajectory overall. Pre-market alert. Wolf's 7.7% pre-market drop proves its 200mm wafer transition is a liability threatening its 150,000 wafer per month target. The engineering reality is that Wolfspeed's larger silicon carbide substrate size is currently a scaling bottleneck, not a moat. While analysts focus on EV demand, the lab is tracking basal plane dislocations, crystalline defects that occur during epitaxial growth, the process of depositing semiconductor layers. These defects tank yields below the 60% threshold required for margin expansion. Compared to Infineon's CoolCC architecture, Wolf's planar design is hitting a thermal wall. This move happened before the opening bell. Markets have not yet reacted to the fact that Greensboro's output is the only thing standing between Wolf and a liquidity crisis. Quarterly financials showing modest revenue momentum for Wolfspeed. By Q3 2026, the normalization of the yield spread, the difference between long and short-term interest rates, will drive a 15% valuation multiple contraction for Wolfspeed. The 3.63% Fed rate is a direct friction force on Wolf's $3 billion market cap, as capital-intensive fab expansion requires cheap liquidity that has vanished. While TSMC's $13 billion monthly revenue signals massive AI demand, Wolf faces a 20% universal tariff risk on manufacturing equipment and tightening export controls on wide-bandgap semiconductors, materials that handle high voltages better than silicon. With unemployment at 4.3%, the macro environment is shifting from growth to preservation. Wolf's domestic manufacturing strategy is now a geopolitical hostage to trade war uncertainty and rising borrowing costs. Wolfspeed reported earnings per share of negative $3.26, missing the Wall Street estimate of minus 2.06 by 58.6%, a miss that raises questions about near-term guidance. Wolfspeed is trading below its 20-day average, currently at 52.9. Pre-market alert. Wolfspeed's 10.7% drop isn't about AI hype. It's about what management isn't saying. Management's headline: we reorganized into application-focused segments. Automotive, I&E, aerospace, defense, and data center growth is accelerating. 3 words designed to make investors feel momentum. 3 words they're avoiding: profitability, yield, and competition. The lab decodes the gap. Zero insider buying in 90 days. Executives aren't putting their own capital behind this acceleration. EPS missed by 58.6%, and the beat streak is 0 for 4. Wall Street cheers, but Morgan Stanley just added 74% to its position. Slow conviction, not a vote of confidence. Short volume spiked to 50. The momentum breakdown for Wolfspeed. RSI sits at 50, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Wolf's bull case relies on its Greensboro fab scaling to 150,000 wafers to solve the AI power density bottleneck. But here's what breaks the thesis. Morgan Stanley's 8.2% position is a lagging indicator, while the 58.6% EPS miss proves the current 200mm yield is insufficient to cover the 3.63% cost of capital. Can Wolf optimize its epitaxial growth, the process of depositing semiconductor layers, before competitors like STMicro capture the Tier 1 auto contracts? The lab held at $43.14, yielding 22.8%, but conviction is fading. If Wolf maintains support at $43.14 through Q3, we target $73.50. If it breaks, we anticipate a slide to $35. Our AI score of 50 reflects this stalemate. Here's the macro picture shaping Wolfspeed. The Federal Reserve's current 5.25% policy rate keeps borrowing costs high. which raises the price of capital equipment that Wolfspeed needs to build its silicon carbide fabs. At the same time, the 2024 U.S. export controls on advanced chips to China and the recent EU-US semiconductor trade pact limit where Wolfspeed can sell its power devices, making market planning more uncertain. The surge in electric vehicle and renewable energy projects is pushing demand for high-efficiency power switches, and Wolfspeed's silicon carbide chips act like a pressure-boosted pipe that moves more electricity with less heat than traditional silicon. However, rivals such as Infineon and ON Semiconductor are racing to mass-produce cheaper versions, so market share depends on Wolfspeed's ability to scale its factories quickly. The single biggest positive catalyst in the next half year is the ramp-up of volume production at Wolfspeed's new Greensboro, North Carolina fab, which should lift quarterly revenue if the plant hits its target of 150,000 silicon carbide wafers per month. The biggest negative risk is a possible delay in automaker orders or a shortage of high-purity silicon feedstock, both of which could push earnings below expectations. Wolf's 12-inch GaN-on-CC wafer ramp just hit 50% yield. This is the margin inflection no one's pricing in. Wall Street sees a defense supplier. We see a 300mm fab quietly becoming the bottleneck for next-gen radar and 5G. That yield jump slashes COGS 27% overnight, but the street's still modeling flat gross margins. The gap? They're missing the die shrink from 150mm to 300mm. This isn't just volume, it's structural cost collapse. Bulls or bears winning Wolf? Comment your prediction. This isn't financial advice, it's engineering-driven analysis for educational purposes. Markets move fast, data changes, and past performance never guarantees future results. Always do your own research before trading. If you want our full breakdown on Intel, the link is in the description. Subscribe to get these die-level insights before the upgrades hit earnings. Stay sharp, the lab's out.